Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the key to a great peanut butter and jelly sandwich a good investment? In this video we will be analyzing if SJM Smucker's stock is a buy. Could SJM Smucker, stock ticker symbol SJM, be ready for a comeback? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on SJM Smucker. SJM Smucker was founded in 1897 by Jerome Monroe Smucker, a farmer in Orville, Ohio. He began making apple butter from local apples and selling it from his horse-drawn wagon. From those humble beginnings, the company grew and expanded their condiment offerings to include delicious jams, jellies, and peanut butter, as well as pet foods and coffee. Today the company has 18,000 employees globally and is a well-established consumer food brand. Now let's look at the price action. Starting with the 1-year chart, we see that SJM Smucker had a CAGR of about -26%. Zooming out to the 5-year chart, we see that SJM Smucker had a CAGR of -2%. SJM Smucker share price had been in a steady downtrend for some time but has recently accelerated downwards. Not good. A backtest comparing a $10,000 investment in SJM Smucker versus the S&P 500 reveals SJM Smucker's underperformance. While the S&P 500 would have grown the investment to $21,877 or a 16% CAGR, SJM Smucker's ending balance would be only $14,413 or a 7% CAGR. This underperformance is further highlighted by SJM Smucker's higher volatility, with a standard deviation of 20% compared to the S&P 500's 18%. SJM Smucker's returns fluctuated more significantly. SJM Smucker also lagged the S&P 500 in both bull and bear markets. In the best year, SJM Smucker grew by 21% compared to the S&P 500's 31%. Conversely, in the worst year, SJM Smucker fell by 18% compared to the S&P 500's 18% decline. Additionally, SJM Smucker's maximum drawdown, the peak to trough decline, was -29%, significantly exceeding the S&P 500's -24% maximum drawdown. Risk-adjusted return metrics like Sharpe ratio and Sortino ratio were also considerably lower for SJM Smucker compared to a well-diversified index like the S&P 500, indicating lower returns relative to the increased risk. SJM Smucker has consistently underperformed the S&P 500 across nearly every metric over the analyzed period. Now let's hop over to market share and take a look at SJM Smucker's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under food and see that SJM Smucker is categorized under packaged foods. Expanding the packaged foods tab, we can see that SJM Smucker has little market share and appears to be losing market share as denoted by the red color. That is doubly bad. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for SJM Smucker, SJM, and see that the market share is 0.86% out of the publicly traded food, beverage, and restaurant stocks currently in the market. SJM Smucker attracts very little food spend. The 5-year market share CAGR for SJM Smucker is -5.52%. This means that SJM Smucker is losing a lot of market share every year. If we start in 2019, we see that the market share was 1.08%, 1.09% in 2020, 0.96% in 2021, 0.87% in 2022. and 0.86% over the trailing 12 months. This is bad news for shareholders. Let's take a look at the fundamentals to learn more. Gross margin is 37%. This is in line with other food producers. Revenue has compounded at around 1% over the past 5 years and has reached over $8.21 billion most recently. SJM Smucker's revenue is growing, just very, very slowly. Looking at cash flow, we see a 2% CAGR over the last 5 years for operating cash flow, while capex has worsened at 11% CAGR. As a result, free cash flow has fallen at a 4% CAGR. JM Smucker has some problems here. With barely growing operating cash flow and growing capex, the company is at risk of free cash flow continuing to fall. Management should develop some strategies to reignite operating cash flow growth. Weighted average shares outstanding have fallen over the last 5 years, going from 114 million shares in 2019 to 104 million shares most recently. JM Smucker has been buying back shares. Despite the other challenges, JM Smucker does seem to have a commitment to doing share buybacks. Now let's view return on invested capital. Return on invested capital has fallen from a 5.5% in 2019 to -179.7% in 2023. This is very bad. JM Smucker has become less efficient in driving profits from its investments after net income flipped negative in 2023. The catalyst seems to have been a sale of asset in Q1 2023 that resulted in a net loss. I would expect a return to a positive value after at the next earnings report. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 46 days in 2019 to 16 days most recently, JM Smucker has actually improved its efficiency over time. The bad news is that 16 days is still a very high value, though it is nearly 3 times better than the value from 2019. Now, let's look at JM Smucker's debt. The net debt to EBITDA has increased over the past 5 years, going from 3.7 in 2019 to 4.8 most recently. This is a high debt level for a company that already has many other problems. Falling free cash flow may make it challenging to make debt payments moving forward. Last, let's explore dividends. Current dividend yield is 3.9% with a dividend payout ratio of -432%. The negative dividend payout ratio is due to the one-time event that caused net income to flip negative. Still, JM Smucker is likely paying out dividends that its earnings cannot support, as the typically payout ratio has ranged from 46% to 75%. This indicates that the company's dividend practice might not be sustainable. Dividends per share for this company have grown at a 4.8% dividend per share CAGR over the past 5 years and a 6.4% dividend per share CAGR over the past 10 years. JM Smucker is a legacy food producer that is badly in need of a growth catalyst. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for JM Smucker. It is a food company with a gross margin of 37%. The 5-year revenue per share CAGR is 3% and the 5-year free cash flow per share CAGR is -2%. While the gross margin is decent, it is no surprise that JM Smucker is losing market share with dismal revenue growth. Without much revenue growth, free cash flow growth is non-existent. A return on invested capital of -180% is terrible, but should return to the 5% to 6% range by next quarter. Next, the cash conversion cycle of 16 days is pretty bad. Unfortunately, the recent trend does not inspire hope and the worsening metric is likely to continue. Concerning debt, a net debt to EBITDA of 4.8 means that it would take JM Smucker nearly 5 years of earnings to pay back their debt. So from a fundamental standpoint, JM Smucker looks pretty bad. Now let's switch our attention over to valuation. JM Smucker is massively undervalued relative to the S&P 500 with a ratio of -4.5. The price to earnings growth, or PEG ratio, is 1.7, indicating that JM Smucker is slightly overvalued relative to their projected earnings growth. JM Smucker is a historic, classic food company. Their brands are some of the most popular in the world. Yet for all of their brand value, market share continues to decline. There are several reasons for this, some of them being industry-wide issues. With rising food prices, more and more consumers have been turning to store brands as a cheaper alternative. A recent Wall Street Journal article highlights this. We can actually see here that condiments had store brand sales rise 6.6% versus a 0.4% increase for companies like SJM Smucker. Similarly, Sweet snack sales for store brands rose 4.5% while sales for national brands, think Twinkies which SJ Smucker recent acquired, fell 4.3%. Last, pet food, a core focus for SJ Smucker, saw store brand sales increase 7.5% while companies like SJ Smucker saw 1.5% sales decline. While SJ Smucker will likely remain in business for decades to come, I am looking for thriving companies that are not being disrupted. I like to see growing market share, free cash flow, and return on invested capital. Unfortunately, I think SJ Smucker and similar companies will continue to have falling sales and shrinking market share for the next several quarters. For me, SJM Smucker is not going on the watch list. Many thanks for watching. What do you think about SJM Smucker and the decline of legacy food companies? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.